Let me ask you, a lot of people come on this program and they say the biggest risk to growth in the economy right now is the Federal Reserve, because they're not sure if the Fed's going to be able to get through this moment in time where you're winding down this $4.5 trillion balance sheet, and where you're talking about raising interest rates 3 times this year. And maybe if you're talking about growth slowing to 1.75%, you don't want to go too many rate hikes.
So my own view is that while I do believe for this year we should do 2 more rate hikes, that's my base case, 3 for the year, I think the path of rate increases is probably going to be flatter than people are accustomed to. And one of the reasons is this moderating out-year growth. So I think that the challenge to me for the Fed, and one of my challenges, is I think we should be removing the Fed, increasing the Fed funds rate, removing accommodation, but we have to do it very patiently and gradually because we've got a number of these structural headwinds that are not going away.
What about the balance sheet unwind? How much of a worry is that?
I actually think the way we've designed it is to be very gradual, and we don't sell securities, we just don't replace them as they mature. And if you look at what percentage we are of treasuries and mortgage-backed securities, we're a relatively small percentage. So I actually think the rundown of the balance sheet should be eminently doable, and I'm a little less concerned about that.
All right. Let me ask you about this news this week. President Trump announcing his intent to nominate Columbia University economist Richard Clarida to become the central bank's vice chairman. Your reaction?
Well, I know Richard for many years. I think very highly of him, and I'm excited about the prospect of working with Richard.
Has things changed in terms of the in terms of the agenda, in terms of the priorities of the Federal Reserve, with Jay Powell now as chairman?
I think I'm sure we will make changes, but I think there's a lot of continuity. Jay has been around the table for the last 6 years. I've been working with him since I've been on the Fed. So I think while I think we should revisit some of the things we do, I think Jay Powell's selection is a mark of continuity. The other changes around the table, I think, are healthy and good. We are a group decision-making body, and I think when you have rotation around the group, it's a healthy thing, and I think it should be good.
Let's get back to the debt question.
Yeah.
$1 trillion deficits now. They just signed in this $1.3 trillion omnibus plan, which people are up in arms about, because we know where much of the spending growth is. It's the entitlement programs. Yeah. And, you know, we're not in debt because of domestic spending. We're in debt because of the entitlement programs, although this was a total budget buster, this plan. So
the entitlements, $49 trillion is the present value of unfunded entitlements, a record number. But even debt held by the public of the government is up to 76%, which is also a record. So we've got to moderate the path of growth. Now, entitlement reform is one way to do it. The other way to do it is grow faster. And so this is why regulatory review, finding ways to grow the workforce, immigration reform, I think trade is an opportunity to grow faster. All those things are policies we're going to have to get right, because we've got to grow faster to deleverage. And we're a late cycle right now. It is usually at this stage in the cycle you want to be moderating debt growth. We've just ramped it up. It's not something you want to be doing late in the business cycle.
So in terms of the policies on the table right now, a tax plan, rolling back regulations, the trade story seems to be the most worrisome. Do you agree that TPP is not for us, that we should be doing bilaterals? How do you deal with, how do you square this circle in terms of the questions around trade?
So in my job, I'll stay away as central banker. I'll be careful about those policy points. But my point has been this. Trade adds jobs in the United States. Starting with Mexico and Canada. We do a lot of research on trade with both countries. It's primarily integrated supply chains and logistics. 70% of our trade with Mexico is intermediate goods. And so we've got to first shore up those agreements. And then I think the negotiating with China is going to take much longer. But trade's an opportunity for the United States. Right now, people are seeing it as a threat. 15 years ago, it disrupted jobs. Today, if jobs are being disrupted, it's most likely due to automation and technology, not trade.
Yeah.
Trade is a big opportunity for the U.S., and we need to get it right because we've got to grow faster.
Goes back to education, your point earlier, for sure. Robert Kaplan, always a pleasure to see you.
Thanks, Maria.
Thank you so much for joining us. President of the Dallas Federal Reserve.